now is teen librarian over at the Memorial Library, Kinderhook. And I'm going to also just introduce the other gentleman here, the one who looks a little bit like me, is Alan. Alan, can you wave? He is a real-life certified public accountant. I am a real-life certified financial planner and lawyer, and so the two of us together have a lot of degrees in education. And I'm gonna draw on some of his expertise here. So at the end, I'm gonna put him on the hot seat a little bit and just ask some questions about experience with the new tax changes that have come through in the last couple of years, and the ones that what he expects might be coming in the future, because a lot is up in the air. So if you have questions along the way, you can type them into your chat box. For those of you who are watching this as a recording on YouTube, please, I'm about to put up my contact information in a second and at the end. And also, I'm on the board of directors at the library, so walk in anytime and they will know how to find me, and you can always ask questions that way afterwards. So with that, let's get into some Saturday morning tax strategies for 2021. So we're going to start with the boring stuff here of just to remind you that this is for informational purposes only, and Sienna Private doesn't provide tax or legal advice. You should talk to a CPA or your tax professional for more information. I also want to point out that there is no perfect tax management strategy, and every choice has benefits and limitations, so no single approach is right for everybody. So now we can get on to more of the fun stuff. This is me. My contact information is here. Again, I'll put it at the end. I'm a certified financial planner here in Kinderhook, and also with an office down in New York City. And just at the end, we'll have time for questions. As a quick reminder, I can't answer anything about specific financial situations, but again, please reach out afterwards, even if you're just watching this as a recording. Reach out and I'd be happy to see if I can answer some questions then. So before diving into tax strategies for 2021, I thought it'd be good to start with a little bit of an overview of where tax rates have been in history. And they have fluctuated over time, as has the income the federal government receives from taxes. Individual income taxes accounted for less than 1% of GDP in the mid-1930s, but they reached as high as 9.2% during World War II. Where are we now? The White House Office of Management and Budget estimates that individual income taxes will total 8.3% of GDP this year and rise to 8.8% by 2025. And so that compares to the highest that it reached of 9.2% during World War II. So looking at this chart, we can see that the marginal tax rate on top earners has varied over time. In 1915, it was 7%, and then after World War II, the highest marginal tax rate jumped to 94%. It dropped slightly in the years after the war, but it rose again and stayed high through the 1950s. Despite being at 50%, that's right, 50% for most of the 1980s, it dropped and stayed at 28% for 3 years during the late 80s, before rebounding back up to 39.6% in 1993. The highest marginal tax rate dropped a little in the early 2000s, as you can see here, but the 2017 Tax Cuts and Jobs Act reduced the tax rate on the highest earners to 37%. It's scheduled to stay at that rate until December 31st, 2025, and at that point, unless Congress acts, it will revert back to 39.6%. Which makes planning hard because you don't really know yet what's going to happen. So now that we have some historical context, although today's discussion is focused on 21 tax planning, what is the elephant in the room? It is that the tax deadline for filing your 2020 tax return has been extended to May 17th, 2021. I note briefly that the IRS has not extended the deadline for making retirement plan contributions or for making estimated payments, and the states have not yet agreed to the extension. So before you just think you can now procrastinate another month on everything, talk to your tax professional, and make sure you're not messing up one thing just by waiting until the last minute to file your tax return. For today's focus, we're going to discuss 8 specific tax issues. First, we'll talk about current tax rules. We all remember the recent 2017 Tax and Jobs Act, which brought about big sweeping tax changes, and most of these are still in effect, but I'll point out a few changes. Next, Roth Conversion opportunities in 2021, healthcare laws in your taxes, distribution actions, some tax smart asset, location, gift tax exclusions. And if you're still with me, if you're hanging in there, we're going to go into Treasury, Securities, and tax exempt municipals, and finally, giving appreciated assets to charity. So we have a lot to cover. So I'm going to get the presentation moving. And just as a reminder, questions, go ahead and type them. But if we can't get to them, happy to talk to you afterwards. So let's start with a discussion of the current tax rules and some of the new laws that were introduced with the Tax Cuts and Jobs Act of 2017. So for the 2021 tax year, the standard deduction is $25,100 for joint filers, $18,800 for heads of household, and $12,550 for single filers. The state and local tax deduction, also known as SALT, now has a cap of $10,000. The child tax credit stayed at $2,000, and the phase-out increased to $400,000 for married couples. The limits for deducting mortgage interest for buying, building, or improving your home stayed the same, with a maximum of $750,000 in principal value. A few more items that were introduced in the 2017 Act that are still in effect and worthy of noting is that 529 plans, which historically have just been for college education or post-secondary education, are now eligible to fund elementary and secondary education. With 529 plans, it's critical to remember that tax implications can vary significantly from state to state, and some plans in some states may provide advantages and benefits exclusively to their residents. Withdrawals from your tax-advantaged education savings programs that are not used for education are subject to ordinary income taxes and may be subject to penalties. So just be careful before you start withdrawing your 529 plans for something other than higher education. And I recommend you talk to a tax professional or a legal professional for specific information regarding your situation. Another change is you can no longer reverse a Roth IRA conversion. Once you convert a Roth IRA, there's now no going back. So here's something to keep in mind with Roth IRAs. The adjusted gross income, or your AGI phase out, has risen for 2021. So for single filers and heads of household, the range increased to $125,000 to $140,000, and a similar increase for married filing jointly. To qualify for the tax-free and penalty-free withdrawal of earnings, Roth IRA distributions must meet a 5-year holding requirement and occur after age 59 and a half. These withdrawals can also be taken under certain other circumstances, such as a result of the owner's death. The original Roth IRA owner is not required to take minimum annual withdrawals. Another change for the year is that the estate tax exemption has further increased to $11.58 million. Individuals benefiting from the adjustment may want to reevaluate the strategies they have in place to address the tax and liquidity issues related to their estate. The current Biden administration has proposed reducing this estate tax exemption amount to bring it back down to more historic rates, which have been closer to $5 or $6 million in the most recent iterations. To stay within the 10-year budget of $1.5 trillion, lawmakers scheduled many of their 2017 tax law changes to expire. And that's why I'm talking about all these different pieces of the legislation, some that are still in effect and some that are set to expire soon. Some of the key provisions already expired in 2018 and 2019, while others are set to expire in 2025. This table here shows you the provisions as they're structured, and we can take now a little closer look at a few of them. So many of the changes in the 2017 Tax Cut and Jobs Act were targeted at businesses, including a reduction in the top tax brackets from 35% to 21%. For individuals, the most important takeaway is that many of the tax rules are set to expire on December 31st, 2025, which I can't stress that enough, and that's why I keep repeating that date as something to keep in mind as you're doing tax planning for the future. The Biden administration may look to adjust or change some of these tax law provisions before they are set to expire. It's important to remember, however, that legislative changes take time, as I think we all know, and it remains unclear what initiatives may take priority in the months ahead, especially with the ongoing pandemic. Now, in this chart, we're focusing a little bit on long-term capital gains. The highest earning taxpayers pay a 20% tax rate on long-term capital gains. Those in the lower brackets pay either 15% or 0% depending on your income. Now, these tax rates do not include any applicable state taxes, and this is also a point that has been raised by the Biden administration of potentially changing the capital gains tax rate on the highest earners. And just as a quick reminder, you must hold a security for at least 12 months to qualify for a long-term capital gains treatment. If you sell before 12 months, you'll be taking a short-term capital gain, and that is taxed at your ordinary income tax rate, which is generally higher. One way to manage investment-related taxes is to consider taking advantage of a tax-deferred account, such as a 401k, an IRA, an annuity, or a health savings account. These types of accounts have the potential for tax-deferred growth. You may also be able to manage your tax liabilities by revisiting your asset allocation strategy and shifting your investments to assets that generate tax-exempt income. For example, municipal or muni bonds are exempt from federal tax. They may also be free of state and local income taxes for investors who live in the area where the bond was issued. If a bondholder purchases shares of a muni bond fund that invests in bonds issued by other states, be aware, because you may have to pay income taxes on the bonds issued by the other states. Also remember that muni bonds may be subject to the alternative minimum tax. It's important to remember that an investment strategy should reflect your goals, risk tolerance, and timeline. As important as taxes are, and as much as we love to talk about them, they should only be one factor to consider when creating your investment strategy. So let's take a deeper look now at 401ks and traditional IRAs and how some of the contribution limits have changed for 2021. Catch-up contribution limits went up slightly this year, but there was no change in the regular contribution limits. Taxpayers may now contribute up to $19,500 to their 401ks, 403bs, most 457 plans, and federal thrift savings plans in 2021. The catch-up contribution limit for employees 50 years or older has increased to $6,500. The limit on IRA contributions stayed the same for 2021, with a maximum amount at $6,000. Individuals aged 50 years or older can make catch-up contributions of an additional $1,000. As you consider your choices, remember what we discussed a couple images ago. Under the Secure Act, in most circumstances, you must begin taking required minimum distributions from your 401k or IRA or other employer-sponsored retirement plan in the year you turn 72. Withdrawals are taxed as ordinary income, and if taken before age 59 and a half, may be subject to a 10% federal income tax penalty. Also, contributions to a traditional IRA may be fully or partially deductible depending on your individual circumstance. Now we will see slight changes to IRA deduction limits and Roth IRA cutoffs based on the new rules, and the tax deduction for traditional IRA contribution phase-out ranges depends on your filing status and your workplace retirement plan coverage. Converting from a traditional IRA to a Roth IRA offers tax-free withdrawals on taxable contributions. To qualify for the tax-free withdrawal or earnings, a Roth IRA must be in place for at least 5 tax years, and doesn't need to have been all the funds in there. It just needs to have been established and in place for 5 years. And the distribution must take place after 59 and a half, or due to death, disability, or first-time home purchase, in which case you can pull out a maximum of your lifetime of $10,000 from your Roth IRA. Depending on state law, Roth IRA distributions may be subject to state taxes as well. The IRA, or the individual retirement account rollover limit rules, remain in effect for 2021. The rule was established in 2015 and allows taxpayers one IRA rollover from one account to another during a 12-month period, no matter how many IRAs they have. Under the Secure Act, in most circumstances, once you reach age 72, you must begin taking your required minimum distributions, also known as your RMDs, from a traditional IRA. Withdrawals from traditional IRAs are taxed as ordinary income, and if taken before age 59.5, may be subject to a pretty steep 10% federal income tax penalty. Under the Secure Act, you can continue to contribute to a traditional IRA past age 70.5, as long as you meet the earned income requirement. This rule does not apply to trustee transfers, in which account holders don't directly receive the money. So if you're moving your account from one custodian to another. It also doesn't apply to Roth conversions or rollovers between a 401k and an IRA. For example, if you leave an employer and you want to bring your 401k over to a new custodian in an IRA, that's not included in this. The 60-day limit still applies to all rollovers, and this means that when you withdraw money from your IRA, you have to get the money back into an IRA within the time limit or risk paying taxes and penalties. Before deciding whether to retain assets in a 401k or roll over to an IRA, which is something that in switching jobs, a lot of people have to decide, should I leave it in a 401k? Should I leave my assets in the 401k? Should I roll it to my new employer's 401k, or should I just take it out and put it into an IRA? What you should consider are various factors, but including but not limited to investment options of the 401k providers or at the IRA, fees, expenses, services, withdrawal penalties, protection from creditors and legal judgments, required minimum distributions, and possession of employer stock. It can send you to the investor alert section of the FINRA website, and you can find some additional information there. So we've covered some of the highlights of the current tax law, and I know it seems a little overwhelming because it says we're only at slide 2, but that was the hard, meaty part of it. So it'll get a little lighter here. And it's very exciting. We're going to talk about Roth conversions. So while a Roth conversion is not right for everyone, it does provide advantages for some investors, and I do think it's worth at least understanding the possibility it may serve in your plan, because a lot of people aren't even familiar with the ability to do a Roth conversion. So what is a Roth conversion? In a Roth conversion, you may withdraw money from a traditional IRA, pay the federal and state taxes due, and then move those funds into your Roth IRA. And then at that point, all future growth and withdrawals are tax-free. Roths don't have required minimum distributions, which can play a role in an estate strategy. One important detail to note is that you can no longer undo any Roth conversion. If that's something you want to discuss, take a quick note, and we can talk about it in a further discussion. So you do need to make sure you really are committed to making this Roth conversion. There's some other considerations when converting a traditional IRA into a Roth IRA, and this includes that you may want to start a Roth conversion you may not want to start a Roth conversion if it will significantly increase your current tax burden. You may reduce the benefits of the Roth IRA conversions if you use IRA funds to pay the conversion tax. So instead, if you do the conversion, you need to pay the tax. It's preferable to take funds from outside of the IRA, take it from a taxable account, so that way you're not eating into that tax-advantaged money to pay the conversion tax. And then while a Roth conversion may be a good choice for your financial goals, I have to tell you again that you should consult with a professional to make sure the decision would work for you, because it's a very individual consideration. So converting from a traditional IRA to a Roth IRA offers tax-free withdrawals on taxable contributions. To qualify for the tax-free withdrawal or earnings, a Roth IRA must be in place for at least 5 years. And as I mentioned before, the distribution must take place after 59.5. So we're going to talk a little bit about healthcare laws and how they affect your taxes. In an earlier video that you can find on the Kinderhook YouTube channel, we did a whole entire presentation just about paying for healthcare costs in retirement. And this talks, right now I'm just going to talk briefly about the taxes and how it impacts you. But if you have further questions about healthcare costs in retirement in general, I encourage you to see our previous recording. So in 2013, 2 healthcare taxes came onto the books: the additional Medicare tax and the net investment income tax. Let's start with the Medicare wage tax. So as of 2013, high-wage individuals pay an additional 0.9% on wages above a certain threshold. Who's subject to the additional tax? If you're married and file federal taxes jointly, you're subject to a 2.35% tax on your combined wages that exceed $250,000, as compared to the 1.45% tax you pay on wages below that threshold. If you're married but file a separate return, the additional tax will apply to wages that exceed $125,000. For everyone else, the threshold is $200,000 of wages. And here you can see, I can give a quick example. A single individual in 2021, if you have wages of $240,000, you'll owe tax at a rate of 1.45% on the first $200,000 of wages and a rate of 2.35% on the remaining $40,000 of wages. The second Medicare tax affects investment income, also known as unearned income. Before 2013, you didn't have to pay Medicare tax on investment income. With the net investment income tax, however, certain high-earning investors have to pay an additional 3.8% tax on income received through investments. These are individuals who have modified adjusted gross income above $200,000, people who are married filing individually with an AGI above $125,000, and for couples filing jointly with an AGI or adjusted gross income of more than $250,000. Some estates and trusts are also going to be subject to this tax. The net investment income tax applies to many types of investment income, includes dividends, capital gains, rents and royalties, non-qualified annuity income, and any business income considered a passive activity. The tax, however, does not include retirement plan withdrawals, Social Security benefits, and several other income types. These threshold amounts, I just quickly note, haven't been indexed for inflation, and that means they haven't changed since 2013. That means they will potentially affect more taxpayers each year as wages go up, but the tax rate stays the same. So if you spend a relatively large amount of money on health-related services, you may be able to deduct those expenses from your taxes. For 2021, you can deduct medical, dental, and other healthcare expenses that exceed 7.5% of your adjusted gross income, and that's up from 10% in 2020. These expenses include those associated with diagnosing, treating, or preventing diseases such as prescription drugs, some insurance premiums, medical equipment, and travel costs for appointments. But remember, you may not be able to deduct any reimbursed expenses. So now let's take a look at some details you should consider when taking your retirement distributions. And again, I'm going to just refer you, if you have further questions about income, taking income in retirement, we have a video for that already up on the Memorial Library YouTube channel. And right now, I'm really just going to be focusing on the tax elements of it. So some ways to potentially avoid tax pitfalls when taking your distributions from your retirement accounts. First, inventory all your potential sources of retirement income. The list might include all your retirement accounts and any other accounts you manage. Next, review the tax treatment for each item and how a change to your income sources would affect your taxable income. An example is if you move money from a taxable account to a tax-deferred account. Next, determine whether you should consider adjusting your asset allocation to move assets into tax-deferred accounts or to maximize contributions to reduce your reportable income today. Asset allocation is an approach to help manage investment risk and does not guarantee against investment loss. Next, you can find out the distribution rules for your retirement assets. Under the Secure Act, in most circumstances, you must begin taking your required minimum distributions from your 401k plan, Traditional Ira, or other employer-sponsored retirement plan in the year you turn 72. Withdrawals are taxed as ordinary income, and if taken before age 59 and a half, I'm going to remind you again because it can't be repeated enough, it can be subject to a 10% federal income tax penalty. So you should create a strategy to minimize taxes now, especially if you fall into the highest tax bracket, and determine when you will pass your assets to your heirs. And I understand that if some of this information seems confusing or complex, making an informed choice for your distributions is critical, and another reason you should consult with a financial and tax professional to see how these rules can apply to you specifically. So on to our next discussion of asset location. Asset location, not to be confused with asset allocation, attempts to manage your tax liabilities by taking advantage of the different tax treatments that some investments offer. Using this approach, some investors strive to maximize their after-tax returns by strategically determining which securities to hold in tax-deferred accounts and which to hold in taxable accounts. So how do you know what's best for your assets? Well, a sound strategy depends on several factors, including your age, time horizon, and risk tolerance. And if you'd like to explore asset location to see if it's an appropriate strategy for you, I again strongly advise you to consult with a financial professional, because it's a very personal case-by-case discussion of where assets should be held in your best interest. So let's talk a little bit now about getting the most out of your annual gift tax exclusions, which can be a powerful estate tool and which I've seen a lot of confusion around. I hear people say, I know I can give $12,000 or $10,000 to my kids. I don't know why that is, but I know I'm allowed to give that every year. So let's talk a little bit about where those numbers come from. So $10,000 used to be the annual gift exclusion amount. It's now moved up to $15,000. But what does that actually mean? Does that mean you actually can't give more than $10,000 or today $15,000 a year to your kids? No, it doesn't. Today's gift tax exclusion of $15,000 means you can give that amount to anyone in 2021 without having to use your lifetime gift exemption amount. It doesn't actually limit the amount you can give. As long as you limit the gift each year to that year's exclusion amount of the $15,000, the IRS doesn't require you to file a tax return. It's not that you would owe taxes, it's just that you don't have to file a tax return, and you're not eating into your lifetime annual exemption. And what is your lifetime annual exemption right now? It is for a joint couple, 11.7, for an individual, $11.7 million. So if you don't plan on gifting or dying with $11.7 million as an individual, you really don't have to worry about your gift amounts. It's just that if it's over $15,000 per recipient, you then are supposed to file a gift tax return with the IRS. The simplest way to use the annual exclusion is to give cash or other assets to as many people as you want each year. So you can give more money to individuals by making direct payments to certain qualified medical, dental, and tuition expenses, as these payments don't count against your annual or lifetime gift exclusion. And I would just note it's per person is the recipient. So for example, if you're a couple and you have 3 children, the 2 parents could give a total of $90,000 to their children. That's $15,000 to each child by both parents. And again, even this, what seems like a large sum of money for a gift of $90,000 does not apply to the lifetime exemption. So they don't have to pay any gift taxes or even file a gift tax return. So we're nearing the end of our morning tax points here. In just a few left, I'm going to move on to highlight Treasury, Securities, and Tax Exempt Municipals or Munis, which have been increasingly in the news of potentially getting more coverage for an investment place. So a few points on Treasuries. Treasuries typically offer interest rates lower than other taxable fixed income investments. Many investors choose Treasuries because they're backed by the full faith and credit of the U.S. government. As a low-risk investment, Treasury securities can play a role in a diversified portfolio. The government guarantees the timely payment of the principal and interest on the Treasury bonds and bills. If held to maturity, they offer a fixed return rate and a fixed principal value. However, the value of the bond is not guaranteed and will fluctuate, which can impact you if you end up needing to or wanting to sell the Treasury before it matures. Treasuries can also provide some tax benefits. First off, the interest on Treasuries may be exempt from state and local income taxes. So for high income taxpayers who live in states with a high income tax, such as our state of New York here, investing in Treasury bills, bonds, and notes has the potential for additional tax savings. However, you need to remember that Treasuries may be subject to capital gains taxes. So if you sell a Treasury at a gain, you may have a taxable gain. Now, municipal bonds may also be helpful for creating tax-free income. When you buy munis, you're essentially lending money to local, county, state, or other government agencies. Government entities promise to pay you interest and to return your principal by a certain date. Governments use the bond money for the construction of schools, roads, hospitals, and other types of public projects. And as you can see on the slide here, defaults of muni bonds are pretty rare. Between the period of 1970 and 2019, there was only a 0.08% annual default rate of all rated municipal bonds. Munis generate income that may be exempt from federal taxes and, in many cases, state and local income taxes too. However, not all muni bonds offer income exemptions from federal and state taxes. So you should also keep in mind that munis are subject to availability, price, and market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise. Interest income might be subject to the alternative minimum tax, and if sold prior to maturity, capital gains tax could apply. Muni bonds are subject to a variety of risks, including adjustments in interest rates, call risk, market conditions, and default risk. If a bondholder purchases shares of a muni bond fund, and I mentioned this earlier with bond funds before, that invests in bonds issued by other states, the bondholder may also have to pay income taxes. So you need to make sure in buying muni bond funds, what the underlying states where the munis are being issued is, if you're looking to make it a state tax-free investment. So my last point here is going to be about giving to charity, and I left this topic for last so I could focus first on helping to ensure your financial house is in order before examining how you support the causes you care about. Ultimately, one of my primary goals as a financial advisor is to help clients build financial lives that reflect their values, and often charitable giving is an important part of that. So I'd be remiss if I didn't mention that thanks to certain tax considerations, giving in the proper manner may be able to provide you, as a taxpayer, worthwhile tax deductions. And if charitable giving is important to you, again, please reach out and we can discuss ways to maximize your charitable giving budget to have the most financial impact. If you are planning to give to charity, one tax-efficient way to do so is by donating appreciated stocks, bonds, or mutual funds rather than selling them and giving cash. Donating the asset instead of the cash eliminates the requirements to pay the capital gains tax on the sale. You may be able to get a tax deduction for the property's fair market value if you give to a qualified charity. And at the end of 2015, Congress made the IRA charitable giving tax break permanent. This enabled taxpayers who are 70 and a half years old to make donations directly from your traditional IRAs. Now, taxpayers who are subject to distribution rules, those pesky required minimum distributions that we discussed earlier, can use all or part of their distributions to make what's called qualified charitable distributions, or QCDs, directly to the qualifying organization, thereby bypassing any ordinary income tax that might be due on the distributions. Well, I don't see any questions.
I'm doing yours.
I just want to thank you, and I hope you all have a lovely weekend, and to see you over at the library soon. And we'll keep you posted of future seminars. So have a good weekend.
All right. Thank you very much, Marisa and Alan. I'm going to stop recording now.